Hi, my name is Casey Franchini with Brick by Brick Wealth. Today I'm going to share with you how to qualify for a mortgage on a rental property. Investing in real estate is a great way to build wealth. It provides immediate income for your family, and over time the income on that one property grows. The great thing about having a mortgage with a rental property is that your tenants are the ones paying your mortgage. And not only that, you're getting a little cash flow on the side as well. And when your tenants have paid off your mortgage, you're getting almost 100% of your rental payment as positive cash flow. Now, the more you can qualify for a rental property, the more houses you can buy. So before we get started, please hit the like button, subscribe to my channel, and hit the bell so you can be notified of future videos about real estate investing. One of the most important things that factor into qualifying for a mortgage on your rental property is your debt to income ratio. Many people think it's income, but it's just not the most important. With income, you can make $100,000 a year, but if you're paying thousands and thousands of dollars a month in credit card debt, car payment debt, and other luxuries, you'll be able to afford squat. The debt to income ratio is something some people don't truly understand, but it's definitely necessary if you want to qualify for a mortgage on a rental property. To get the debt to income ratio, you need to find out the total amount you owe every month on everything and divide that by your gross income. Your gross income, you say, what is that exactly? Well, the gross income is the amount of money you make before taxes and expenses. It's not the net income, which is the amount you deposit from your paycheck. It's the whole amount you make before deductions. A lot of people don't look at their total monthly expenses, but instead they look at how much they owe overall. And people may spend years trying to pay down student loan debt when really that's not what's needed. What matters is how much you pay per month on that student loan debt. That's the amount that will be factored into your debt to income ratio. And if you have a very low interest rate for your student loan debt, which most people do, and let's say it's only 3%, or let's say you only maybe pay $50 a month on your student loan, that really isn't very much. But take a look at your credit card bill. Are you carrying a balance? Are you paying $800 a month in credit card debt? Do you pay $500 per month for your car? Those are the types of things that make a difference to your debt to income ratio. You need to add up all of your monthly payments and divide that by your gross income. Lenders want to see 35 or 36% of debt to income ratio. The more you get up to 50% of DTI, which is debt to income ratio, the less you will qualify for. So lowering your debt to income ratio, or in other words, lowering your monthly expenses, is what is key. Whether that's getting a lower interest rate to reduce your monthly payments, or even paying off some of your high interest items first, that's what you should be thinking about so you can qualify the most for a mortgage on a rental property. The next important thing is your credit score. You may be able to buy an owner-occupied house if you have a low credit score by using an FHA loan, but buying a house as an investment property, like non-owner occupied, if you have a low credit score, is going to be difficult. Why? Well, it's already a risk for the bank to loan you money for a house that you won't be living in. They will charge you a higher interest rate just for that right out of the gate. And the lower your credit score, the higher the interest rate will be for you, which will eat right into your cash flow. If you're buying an investment property yourself, you'll want to use a conventional loan, and you'll need to put a minimum of 20% down. Different lenders do offer different programs for investment properties, and the amount that you put down will depend on your credit score and what income sources you can provide. All lenders have a couple different loan options, so you can search around. You may be required to put 30% down for a non-owner occupied investment property. So, like I said, check around with different lenders and mortgage brokers. The important thing to note about the credit score is that the higher your score, the better the rate you will get to get a conventional loan. And you're going to need at least a credit score of 620. If you're looking to get a large jumbo loan over $350,000, you're going to need a minimum credit score of 700. But if you want to get the best rate, which is the most important factor in getting a low mortgage payment, you'll want your credit score to be the highest it can be. Anything over 760 is good. 850 is perfect, but anything over 780 is super duper awesome. So we've talked about the debt to income ratio, and we talked about your credit score. So what's probably lingering now is still the income requirement. And yes, you will need income to qualify for any sort of loan. But don't get frazzled thinking you won't have enough to buy a house. Let's first start off with how much you can afford right now. So to find this, let's use an example. Get out your calculator real quick and you can figure this out super easy. It's called the rule of 28. So for my example, you can put in your own income if you want for your own example. But for my example, let's say you make $50,000 per year. You take $50,000 and times it by 0.28. Then divide that number by 12. And the 12 is for 12 months. And you now have $1,167. So now lender can try and find you a loan where you will pay a maximum of $1,167 per month for a mortgage. There are many different loan types. Did you know that there are way more options than just a 30-year loan at a standard interest rate? There are 40-year loans also. There are also 5/1 ARM loans, where during the first phase of your loan, you can get a much lower interest rate and payment. So if you plan to sell in 6 or 7 years and move up to a better cash flowing property, a duplex, a fourplex, or more, a 5/1 ARM could be a smart choice. Don't limit yourself on your income. Talk to a loan officer and see what your options are. And if you're ready to take the plunge right now and get started in the real estate property investing world and you'd like some guidance, I'm putting together a course on how to invest with rentals from A to Z. Sign up below so you're the first one to know. I have some awesome freebies coming up for the first people in my course launch. Meanwhile, check out my most recent video, 10 Steps to Buying a Rental Property. It covers more ground on what you need to know when going through the loan process of buying your first rental house. And if you are an inspiring investor, I'm giving away a free digital download of a sample blank tenant application that you can use right away. And I also include a guide to the top 5 things that I require tenants to have before they can sign a lease. There is a direct download link right below the video in the description box. If you learned something in this video, please like the video below and subscribe. And don't forget to ring the bell so you can be the next to know about my next videos on real estate investing education. I'm Casey Franchini, and thank you so much for watching Brick by Brick Wealth.